My name is Peter Sleegers, and I'm going to introduce Daniel Meritero, both of Cowell Clarke's Tax and Revenue and Superannuation Group. Today we're going to talk about the transitional capital gains tax relief for self-managed funds that arose out of the sweeping changes to the superannuation tax system last financial year. This is a fairly targeted session. We're really wanting to address the issues that concern SMSF advisors, specialist advisors, including licensed accountants. It probably will have some relevance also to sophisticated trustees that would have had a superannuation account balance paying a pension in excess of 1.6 million last financial year. Without further ado, I'm going to hand over to Daniel, who's going to go through the mechanics, and then I'm just going to take up some planning points at the end.
Well, thanks Peter, and thanks everyone for joining us. Just some brief observations in relation to the operation of the relief. It is a choice, so it won't apply automatically, and the choice needs to be made in the approved form. So the approved form is the CGT schedule to the fund's 2017 income tax return, and that choice needs to be made in that form by lodgement time. So for most funds, we'd normally expect 15 May 2018 to be lodgement time, although the ATO has recently extended that time to 30 June 2018 to allow sufficient time for advisors and trustees to make the necessary choices. The relief will apply differently depending on whether the fund has adopted the proportionate approach or the segregated assets approach during the pre-commencement period. That period is the period from 9 November 2016 to 30 June 2017. Normally we'd expect to see, if the fund has been adopting the segregated assets approach, some evidence that specific assets have been set aside to fund the pension liabilities of the fund. The one rider on that is the ATO view that situations where all of the assets of the fund have been paying current pension liabilities, then the fund will be taken to be adopting the segregated assets approach. So just need to be mindful of that when determining which method has been applied by the fund. Where the segregated assets approach has been adopted, relief will be available if the asset was segregated at that 9 November 2016 date and was subsequently desegregated. The asset will be taken to have been disposed of and reacquired by the fund at the time it was desegregated. The capital gain, of course, will be exempt on the normal segregated asset rules in relation to determining the exempt income. Under the proportionate approach, the relief will be available if the fund had determined its income under the proportionate approach during the pre-commencement period and the asset was never segregated during that pre-commencement period. There is a slight timing difference to be aware of because under the proportionate approach, the deemed disposal and reacquisition is taken to occur at 30 June 2017 or just before 1 July 2017. Under the proportionate approach, there is the concept of a deferred notional gain because part of the capital gain arising under the application of the choice of the proportionate approach will give rise to an assessable amount. The 1/3 discount can be applied against that gain, but capital losses are not applied at that time, but can be applied at future when the asset's ultimately realised and the deferred notional gain is brought to account. So that gives a basic overview of the mechanisms associated with the CGT relief, and I'll now hand back over to Peter, who will talk through some of the planning issues associated with the relief.
Well, thanks Daniel for that overview, and just to finish up now, I'm just going to go through a few practical pointers and planning issues. One of the things you might ask yourself is, are there circumstances where the choice shouldn't be made? Naturally, for the reasons Daniel's gone through, if you've got unrealised capital gains in a fund, normally that will be beneficial. But just bear in mind there are some exceptions to that. One obvious one I can think of is a situation where you might have had two members, one in pension phase, another in accumulation phase, but with a significant account balance as at 30 June, where that accumulation member then starts a pension, perhaps because they've become eligible, after 30 June 2017. In those circumstances, you're obviously going to get a higher tax exemption in the fund, given the proportion of assets that are used to apply for paying the pensions. So you'd certainly want to think about whether it's better to not make the CGT choice and lock in the exemption as at 30 June in that scenario. Another planning issue we're coming across quite regularly is what about capital losses? Is it worthwhile to crystallise the capital losses? Daniel's mentioned the deemed disposal. That will give rise to a capital loss if indeed the value of the asset is worth less than its cost base. The issue to think about there is, although you might be able to use capital losses against other capital gains in the fund, by doing that, don't forget that with the proportionate approach, Daniel's mentioned that you can still use capital losses against the deferred notional capital gain, so they're not lost as a result of not making the choice. So something to think about there. One other issue we're seeing quite a bit in practice is with SMSFs that have invested in unit trusts, and those unit trusts have underlying real property. Don't forget that the relevant asset there is in fact the units and not the underlying property. So if the property is sold down the track, that's not a realisation of the CGT asset for the purpose of this legislation. And we are certainly seeing some interesting permutations with those scenarios where superannuation funds have held units in unit trusts. And the final point I'd like to take up is just one that I think most people are aware of, but something just not to forget about, and that is you can compromise access to the CGT choice where, for instance, you weren't segregated as at the start of the pre-commencement period, but during that period all of the assets were used to fund pensions. In those circumstances, the tax office take the view that you can't apply either method, you can't apply the CGT choice, and we've had a good look at the legislation on that point. There are arguments that can be made to the contrary, but we think the ATO argument is pretty strong, so just look out for that, particularly if you might be taking over the work of somebody else and need to investigate the history. So look, they're the planning points that I want to raise. I hope you found this session really useful. There is more information on this in the Cowell Clarke SMSF Income Stream Guide that you can acquire through the Tax Institute. And of course, we're in the business of providing advice in this area, so if you need any assistance, please feel free to contact us. Thank you very much.